Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. We are from Group 2 of Seminar on Tax Management in International Accounting degree. We would like to present about our topic with the title Tax Management in the Selection of Financing Resources. But before that, let me introduce myself and my group members. My name is Richard Julian Antonio and my group member is Shaquila Dania Putri. Next slide, please. And there are 4 topics in this presentation. The first one is retained earnings advantages. The second one is debt financing and equity financing. The third one is factoring and leasing. And the last one is hybrid financial instruments. And the next 2 topics will be presented by Shaquila Dania Putri. To Shaquila, time is yours.
Okay, I will explain about tax management and the section of financing source. Every company must have a goal to maximize the wealth of the owners. The maximum owner's wealth is reflected the maximum company value. To achieve this company's goals, one of the important factors in terms of finance is how the role of financial managers in managing funds. Fund management includes how financial managers obtain efficient sources of funds and allocate them or invest them effectively. With optimal management in terms of funding and investment, the company's goal is to maximize wealth the owner of the company can be reached. So the first topic is retained earning advantage. The retained earning is a term for unshared profit, or in other words, the definition of retained earning is the whole or part of the company's profit for a certain period which is not distributed to shareholders as their dividends. What is meant by dividend is the distribution or profits to the company's shareholders according to the percentage of their share ownership. The decision on the retained earning is a joint decision at the general meeting of shareholders. The decision is taken by looking at the company's financial condition, marketing strategy, and operational funding needs in the next period. For the significant benefit, retained earnings have several very significant benefits for the company's operations. The first is to pay company's debt. The first benefit of the retained earnings is to keep the company running and the good name of the company is maintained. The debt obligation must be paid. Therefore, companies can plan debt payment with retained earnings, especially debt that will soon be due. The second is to finance company operations. In carrying out its operation, a company must have sufficient funds, including funds in large cash and petty cash. Retained earnings are also useful for financing the company's operation with the aim that the company can continue to operate in the hope that it will continue to grow bigger. The third is as reserve capital. Another benefit is a capital reserve if one day the company experiences financial constraints. With the funds from these profits, it can be additional funds so that the company can continue to run well without the need to borrow money from other parties such as banks. And the last one is for the company's future development or investment. The company, of course, must not run statically or decline, but must continue to rise and innovate so that it continue to exist and develop. This profit can be used in business development or company's investment, including investment in other business. There are several factors behind the occurrence of retained earnings, which are the first is changes in company management. Changes in organizational structure in company management can be the background for the occurrence of retained earning reports. The goal is that the new management is able to adjust and show its performance in managing the company's finance. Retaining earnings due to This factor also aims to maintain work stability and suppress fraudulent action. The second is there is an error in the financial statement of the previous period. Another factor is an occurrence of error in the financial statement of the previous period. In the case, the company must first correct the financial statement until they are valid and then recalculate the value of the retained earning report correctly. The third is rupiah value adjustment from previous period. The next factor was due to an adjustment in the value of the rupiah which had changed. The rupiah exchange rate that rises and falls at any time will affect the results of the company profit calculation, so that the accountant decided to hold back the existing profit. The fourth one is there is a change in calculation method. Factors that change the calculation method can also be the cause of retained earnings. For example, the previous calculation method always used a monthly system, and then suddenly it was changed to weekly, then it would be confusing. The last one is changes in accounting principle from the previous period. Factors that can also influence or changes in accounting principle from the previous period, where these changes occur quite significantly and affect the value of the statement of retained earnings. Calculating retained earnings. First of all, we can calculate the gross profit. The formula for calculating gross profit is sales figures minus cost of goods. After calculating gross profit, then calculating operating profit with the formula gross profit minus operating expenses. After operating profit is obtained, the next step is to find out net profit before tax, which are operating profit minus interest, depreciation, and amortization. Depreciation and amortization is the depreciation of the value of an asset, which are tangible and intangible over its economic life. And next, we can calculate the net profit after tax. The net profit after tax is obtained from net income before tax minus the tax rate. If net profit after tax is obtained, then it can be calculated using formula net profit after tax minus dividends. For the second material is debt financing and equity financing. For a limited liability company or PT to operate, it first needs funds, even after a business activities are running. PT may require more funds for various reasons, such as business expansion. In general, company financing methods can be divided into two types, which are debt financing and equity financing. The debt financing. What is meant by debt financing? Or financing through the debt means that the company borrows funds from external parties, which in the future, the company must return the principal of the debt along with interest from the creditor. Financing through debt itself can be divided into several forms, such as notes or bonds, loans from financial institutions, or issuing securities. For the advantage and the disadvantages, for the advantage, there is no change in the company's share ownership. The second is company policy cannot be intervened by creditors, and business owners remain in the control and do not have to share profit with creditors. And lastly is reduced tax deduction. For the disadvantage, along with the advantage, there are interest fee and loans must be returned within some time, and unresolved loans cause the company's financial records to be bad. And the second is equity financing. On the other hand, company financing through equity or equity financing means the company raises capital by selling its shares. Investors who buy shares provide capital to the company, which can later be used. In this case, the capital does not have to be returned to investors, but investors as shareholders are entitled to dividends. They can also receive a profit by reselling their shares if the shares price rises. The same as the debt financing, the equity financing also have their own advantages and disadvantages. For the advantages, there is no interest fee in the equity financing and no loans to be returned. And lastly is obtain business contact and management expertise from involved investors. Along with the advantages, the disadvantages would be the company would share ownership changes. The second is company policies can be intervened by investors and business owners can lose control. And the last one is must share profits with creditors. The next material will be explained by Richard.
Okay, thank you, Shaquila. The third material is factoring and leasing. Next slide, please. Factoring. Factoring is a financial transaction when a company sells its receivable, for example, bills, at a discount. There are three differences between factoring and bank loans. First, factoring is on the value of the receivables, not the creditworthiness of the company. Second, factoring is not a loan, but the purchase of an asset or receivable. Lastly, bank loans involve two parties, while factoring involves three parties. Next slide, please. The three parties involved in factoring are seller, debtor, and the party who finance or factor. The seller is the party that has the receivables, usually for services rendered or goods sold, from a second party, the debtor. The seller then sells one or more of his bills at a discount or discount to a third party, a specialized financial institution for cash. The debtor will pay directly to the finance company with the full amount according to the invoice value. Next slide, please. The benefits of factoring are lower production costs, provide prepayment facilities, improve the competitiveness of client companies, improve the client's company's ability to earn profit, avoid losses due to bad credit, and the last one, speed up the economic process. Next slide, please. Leasing. Leasing is a contract between the owner of the asset, called the lessor, and another party who uses the asset, called the lessee, for a certain period of time. One of the benefits of leasing is that the lessee can use the asset without having to own the asset. As compensation for the benefits enjoyed, the lessee has an obligation to pay periodically for the lease of the asset used. Another benefit is that the lessee doesn't have to cover maintenance, taxes, and insurance costs. Next slide, please. There are three leasing forms, which are sell and leaseback, operating leases, and financial and capital leases. The first form is a sell and leaseback where companies that own assets such as land, buildings, and factory equipment sell these assets to other companies and at the same time lease back the assets for a certain period. The buyer of the asset can be a bank, insurance company, leasing company, pawn shop, or individual investor. Usually, these assets are sold at market prices. The benefit of this sell and leaseback is that the seller of or lessee receives immediate payment in addition to funds that can be invested in other investments. And at the same time, the lessee still use the assets sold during the term of the lease agreement. The lessee has an obligation to pay periodically the selling price plus the profit rate required by the lessor. The second form of leasing is operating leasing, which is often called service leases or direct leases. In this type, the lessor provides funding as well as maintenance costs, all of which are including in the lease payment. The main characteristic of this form of leasing is that the cost of the assets as a leasing object is not fully amortized. In other words, the payment required is not sufficient to cover the entire acquisition and maintenance cost of the asset. However, The term of the operating lease is usually shorter than the expected economic life, so the lessor hopes to lease it back to another party or sell the assets to cover the acquisition costs, maintenance costs, and the required level of profit. And the third type of leasing is financial leasing or capital leasing. This form of lease that differs from operating leases in that the lessor doesn't bear the maintenance costs, can be cancelled, and is fully amortized. Thus, the lessor receives payment at the cost of the asset plus the required rate of return. In general, the lessee must also pay taxes and insurance on the object's assets. Next slide, please. And the fourth material is hybrid financial instruments. Next slide, please. One of the financial instruments currently widely used by companies in investing is hybrid financial instruments. From a commercial perspective, financial instruments innovation using hybrid financial instruments will provide benefits for companies when facing large investment risk. According to Duncan, hybrid financial instruments are defined as financial instruments that have inconsistent economic characteristics, either partially or completely with respect to their legal form. Next slide, please. Meanwhile, the OECD defines hybrid financial instruments as financial instruments that are classified differently among the countries involved in the transactions of these instruments. For example, as loans in one country and as capital in another. Next slide, please. Examples of hybrid financial instruments that are often encountered include preferred shares, silent partnerships, shareholders' loan, participation bonds, convertible bonds, warrant bonds, and the last one, private participation loans. Next slide, please. And that's all about our presentation. Thank you for your attention. And we close by saying, wassalamualaikum warahmatullahi wabarakatuh.